We're talking now about central bank monetary policies with a former head of the Canadian Central Bank, David Dodge. David was appointed the Deputy Minister of Finance of Canada in 1992 and later served as the Governor of the Bank of Canada between 2001 and 2008. We'll be discussing all things monetary and fiscal policies with David, as well as the outlook for the Canadian economy, how to control inflation, central bank digital currencies, gold, and Bitcoin. Welcome to the show, David. It's an honor to have you.
My pleasure.
You were on several important political bodies throughout your career, starting with being part of Parliament, and of course, later you were the head of the Bank of Canada for a number of years. Before then, actually, not many people may know this, but you were a research director of the Anti-Inflation Board in Canada in the 1970s. And we'll be talking about what you've done then, and you're currently writing about some of the policies you've instituted back in the 70s. Let's talk about the current situation in Canada. We are at the highest level of inflation in many years, similar to that of the U.S. 6.8% was the latest CPI reading from the Canadian side. Now, 6.8% is high by historical standards. In your view, David, what do you think caused this rise of inflation in Canada in particular?
Well, it's a combination of factors. First of all, we had the pandemic, which took a lot of people out of the labor force, took out a lot of production, both here in Canada and around the world. Governments compensated for that with a lot of spending to maintain demand, and indeed, I would say we're remarkably successful in that. And central banks accommodated that additional effort by governments, accommodated it with interest rates, policy rates close to zero, and through an expansion of the monetary base, expansion of their balance sheet. So that was all happened from February 2020 through until about the end of 2020, and was remarkably successful in avoiding what might have been an absolute calamity, both here in Canada and around the world. So that was the start of it, the start of where I think we want to pick up the story, right, going forward from there.
Sorry, please continue.
Go ahead.
I was going to add that under your leadership back in the early 2000s, the Bank of Canada had stuck to its 2% inflation target quite religiously, and that period while you were the head of the Bank of Canada, Canada avoided recessions until, of course, 2008, after you had left. Now, back then, the macroeconomic landscape was obviously quite different. Would you have done anything differently today if you were at the helm of the Bank of Canada today versus our current administration? What would you have done anything differently, if anything?
Well, what they did in 2020 was exactly what was needed, and that was equally true for the government of Canada in order to maintain demand through that very difficult period. The story becomes more difficult after that, and by the time we got to a year ago, where we were, what was clear is that the supply capacity of our economy and economies around the world was not responding nearly as quickly as we might have anticipated early on, partly because of ongoing effects of the pandemic, partly because of the deglobalization which was going on, which was restricting supply, partly because of the decarbonization efforts that were ongoing. All these factors meant that the supply capacity by this time last year was not growing as quickly as we might have anticipated early on. So that I think is the nub of the story. And at that point, one can say, and we at Bennett Jones argued a year ago that indeed governments were going to have to restrict the amount of fiscal stimulus they were putting into the economy, and that the Bank of Canada was going to have to end its period of excessive accommodation and begin by the end of the year to raise interest rates. So we were arguing that, but the general view, I think at the time, in fairness, and there was great uncertainty as to how the world would unfold, the general view was that supply would respond fairly quickly. That turned out to be not correct. Governments made that mistake. Economists made that mistake. Firms made that mistake. And so by the time we got to the fall of last year or the beginning of the winter, it was really quite clear that supply was not going to be respond as quickly, and that we would have to contain demand to move demand down, if you will, to meet the supply constraint. I think it's fair to say that the Bank of Canada, I think, had unfortunate communications over that period. They kept saying that this was all going to be transitory and it would fix, which was true, but their definition of transitory, I think, was a little different than what the public took the word transitory to mean, number one. And number two, that they really should have made it clear that they were going to have to move those rates up, and that we would need to get rates up at some point to something approaching neutral, somewhere in the 2 to 3% range. How quickly, of course, was always uncertain, but that's what they should have been. At the same time, the government of Canada needed to exercise even more restraint, and certainly provide the language of restraint and reduce its borrowing faster than what it was doing. But I think all that was true, and the issue of trade barriers and stopping up the flow of goods, especially from China, stopping up the flow by policy, but also because China was struggling in a way that we perhaps didn't realize. All of that ended contributing to the problem. And it means that we're going to have to go through a period where we restrict demand to get it down to a level where we're able to meet what supply was able to catch up.
All right. Now, I believe that it is your view that had central banks, or in particular the Canadian Central Bank, not intervened and loosened monetary policy over the last 2 years, that the country would be plunged into a depression. Is that your view?
Sorry, over the last 2 years, there's a lot of story here, which you're trying to unpack. I think generally what is true is that since 2008, central banks have focused on trying to maintain levels of employment through rather accommodative monetary policy, which probably in retrospect, all through that long period, was a little bit, monetary policy was too accommodative. But that's a longer story. The short story is that the bank again did exactly the right thing in the spring of 2020 in being accommodative in order to get us through the supply shock that came with the COVID.
There are some critics of the Bank of Canada, and in particular, Conservative MP Pierre Poilievre has said that the inflation that we're seeing today in the nation could possibly or partly be caused by loose monetary policy from the central bank. How would you respond to that?
Well, first of all, he doesn't state it quite that rationally. as you just stated it, right? And it's quite correct that governments and the central bank both move to maintain levels of aggregate demand above the capacity of the economy to supply. That is absolutely correct. And not that they did the wrong thing in 2020, but both fiscal and monetary policy didn't respond quickly enough in 2021, and especially in the fall of 2021, when it was quite clear that the supply restrictions, which both business and government and central banks all hoped was going to work their way out quite quickly over time, that was not going to be the case. So I think the criticism that can be levied against our central bank and all central banks is that they were a bit slow in the fall of 2021 to recognize that they would have to begin to move quickly. They now, of course, are compensating from that by moving very quickly.
All right. Well, let's talk about ways that the government, from both the fiscal and monetary policy sides, can do to bring down inflation. Now, previously you were on the anti-inflation board in the 1970s. Let's talk about some of the work you've done back then in the 1970s in regards to price control, wage control, and whether or not any of those measures back then would be deemed appropriate today.
Well, there's one big difference between now and that period of time, and that is that we have had 2 decades of inflation staying really pretty close to the 2% target. And so inflation expectations coming into this period were really pretty well anchored. That was not true in the early 1970s. We had gone through a period since the mid 60s where every year inflation got a little bit worse, in part because the Americans were trying to fight 2 wars at the same time, a war on poverty and a war in Vietnam. And so there was excess demand that had manifested itself over quite a period of time. And then, of course, we had the shock, the first oil price shock in 1973. So that background is really quite different than where we are today, where coming into 2021, expectations were pretty well anchored. And so that is the big difference. And what we had to do with the anti-inflation board, or what we were trying to do, was to move expectations and actions down in line with a decrease in demand coming from both central banks and the government. Today, our problem is that we have to act quickly enough to make sure that we don't have a long period of high inflation where the expectations really become unanchored. Because once they become unanchored, as we know, then the solution to it is a dramatic reduction in demand. And in 1980, you'll recall Jerry Bowie pushed mortgage rates in this country up into the high teens in order to restrict demand. And we had a very, very serious recession.
Our neighbors to the south have different views within their own administration on how to fix inflation. On the left side, you have people like Senator Elizabeth Warren, who have suggested, and of course President Biden shares his views as well, they have suggested that inflation is partly caused by price gouging on the part of corporations, mega corporations, tech corporations like Amazon. And so they're suggesting that they should implement some sort of control on their pricing. Now, is this a view that you agree with, and that's something we should do here in Canada?
No, I don't think we are in the same position. Well, I don't think the United States and us are in the same position we were in the 1970s. And that is that inflation expectations are still pretty well anchored. What we've got to do is to make sure they stay anchored. That is the key thing. And the way you make sure they stay anchored is to move interest rates up quickly on the part of the central bank and continue to reduce stimulus coming from government.
Okay. Now, you've suggested that the interest rate move up to neutral between 2 to 3%. Some economists would argue that perhaps that may not even be enough, David. You'll recall that back in the 80s, Paul Volcker raised interest rates to double digits to fight double-digit inflation. And perhaps we need interest rates near the actual rate of inflation, which in this case in Canada is 6.8%. How would you respond to that?
Well, first of all, what you need is interest rates to be higher relative to the level of expected inflation. And so, as I said, today, inflation expectations still appear to be reasonably well anchored. And so if that is the case, then indeed getting interest rates up to something, maybe at the top of the 2 to 3% band, let's say up to 3%, means that they will in fact then be in line with the expectations of inflation out there. It is possible, David, and we don't know the answer to this, and this is the area of debate. It is possible, of course, that expectations really have become very badly unanchored, as they were in the 70s. And so you're going to need, at that point, you will need supply demand restrictions by both the central bank through raising interest rates, and by the governments of Canada and the provinces by cutting expenditures to indeed provide a real shock to drive unemployment up to a point where that it clearly is exercising restraint in labor markets, wage restraint in labor markets, and thus forcing prices down. So that is the broad picture. I would make one caveat to all of that, and that is as long as we're insisting in driving up natural resource prices by shutting off supply from Russia and the Ukraine and so on, as long as we're going to do that, you can't compensate for that simply by reducing aggregate demand. And so as long as we're pursuing our political strategy in the West is keeping resource prices high, it's going to be very hard for central banks and fiscal policy on the other side to deal with that.
In regards to raising the overnight rate, currently we're about 1%. The Canadian overnight rate is 1%, even to 2%, David, regardless of whether or not that may be enough to combat inflation. But that's still a doubling of the interest rate. We're talking about a doubling of interest expenses on the part of Canadians who have mortgages, car loans, credit card debt, and whatnot. People are worried that they may not be able to afford their current existing loans, hence the slowdown in aggregate demand that you were talking about. Do you think that even at 2% at the overnight rate, that would be enough to cause a potential recession here in Canada?
Well, we don't know exactly. We don't know. We've got a lot of strength in the Canadian economy, so it's going to take quite a bit of restriction of demand to wipe out that latent strength that is there. So can we come through this without having to do what Jerry Bowie and Paul Volcker did in 1980? Can we come through this without having to endure that sort of a recession? I think we can, but it's going to be delicate balancing,
Mhm.
on the part of governments and on the part of central banks in order to get through it.
The Canadian housing market has been under scrutiny by politicians from both sides of the aisle. It's indisputable that the housing prices across the country have risen dramatically over the last 2 decades. Do you think the Central Bank of Canada, though, has had any role to play in asset price inflation? We know that speculative money coming
Sure,
from foreign direct investments have played a role, but do you think central banks have also played a role?
sure, of course they have. And they played a very strong role, in 2020, intentionally, in order to avoid a real problem at that point in time. So the question then remains: have they moved fast enough in the course of 2021, in particular the second half of 2021? To remove that accommodation? And I think the answer was they were too slow in removing that accommodation.
Ah.
And they will now have to move more quickly than they might otherwise. And we might have to endure a slightly longer period of slightly higher interest rates. And that's easy to say in retrospect. But don't forget, at the time, even a year ago, there was a lot of uncertainty as to whether that supply would respond. And I think central banks and governments, both, and most economists, I should say, David,
Sure.
were saying, no, they have to be very gentle in restricting demand too much over that period. That was a judgment call. Turned out not to be an ideal judgment call at that point in time, just as their judgment call in the spring of 2020 turned out to be exactly the right judgment call to make.
Well, there are speculations from market participants, investors. RBC, for example, has recently put out a report saying that they expect the housing market to cool off somewhat in Canada, across Canada, especially the large metropolitan cities, Toronto, Vancouver, for example. Is that a view that you share?
I'm not a housing price expert, and so I want to be careful here. But undoubtedly, raising rates will have a cooling impact on the housing market. Absolutely, it will. Whether it will, if the policy rate goes to 3%, let's say, meaning mortgage rates basically go to 5 or 5.5. Will that cause a dramatic move in prices? I think that's hard to judge. And all one can say is that the move up in 2020 and 2021 was so much that taking back,
Yes.
if you will, taking back some of that rapid escalation through price decreases, month over month price decreases, is probably going to happen and is probably warranted as well.